Okay, so I'm going to get started. First thing is just to highlight context. So you've enrolled in the crash course. So this crash course is the support material that we're going to be looking at. You're going to be seeing lots of theory and calculations covering various topics. The first thing I want to just raise is the study guide that they've sent to you. I see they have improved the study guide. Before, they never gave as many workings and calculations, but I see they have improved it. So if you go look at each chapter, towards the end of each chapter, they've given you some of those additional practice questions that you can actually make use of, just in terms of workings and calculations. So maybe towards the end of today's course, if you have any questions about that, you can definitely ask me about any of those workings. The study guide answers are quite good. They've actually given workings and explanations. Before, they never gave as much content in terms of calculations. They've always asked students to rely more on the textbook. There are newer editions of the textbook. Hopefully you have one of the editions. I see they're still prescribing the second edition. Before, they prescribed the first. Now they've at least prescribed the second. But there's actually a lot of other newer editions available. The textbook's actually very, very good, purely because it's a huge source of information, and the theory has always been correct. I don't know if any of you know, like past, or if any of you have had certain scenarios in the past with UNISA where they have given certain notes, theory or calculations, and there tend to be a few errors or mistakes. And we've picked up a few of this in the past, but this is a few years ago. Looks like they have improved it quite a bit, and I have seen some improvements, so that's always good. And then you do have assignments and exams that you need to obviously complete. The exam is our focus. We're going to be looking at that. Right, so the first thing I need to cover with all of you is just some basic knowledge from FIN3601. Right, all of you would have covered FIN2601 before getting access to FIN3701. There are other finance modules. There's 3702 as well, which is working capital. For this module, you're looking at high-level decision-making from a financial manager's point of view, and you're focusing specifically on long-term financial decisions and long-term financial, investment decisions. So you've got financial decisions and you've got investment decisions. Those are long-term, okay? And then you've got the short-term. The short-term actually isn't covered in this module. It's covered in the FIN3702. Okay, that's the working capital module. That module is a bit shorter, but it uses the same textbook actually. So you just need to keep that in mind. If you are doing FIN3701 and 3702, they both use the same textbook. Right, this is FIN2601 content. You need to know these ratios. Okay, these ratios are key because they can come up in different calculations, right? So I'm just highlighting some theory and content that you would have covered previously that you are going to be needing in certain calculations going forward in FIN3701. Okay, so you've got all of these ratios. They covered these in detail in FIN2601. So I'm not going to spend too much time covering this because you would have looked at it previously, but I'm just highlighting it because it is important in terms of basic understanding. Right? So you've got activity ratios where you've got inventory turnover, your average collection period, you've got average payment period, which is looking at your creditors, and then your total asset turnover. Right? There is a DuPont calculation that uses those different calculations. Well, three formulas. You've got turnover, inventory turnover, you've got average collection period, and you've got average payment period, and you've got total asset turnover. You'll see in one of the slides I've given you a note about DuPont. That's also something that needs to be remembered from previously, where you looked at how return on equity can be split into three different components: the net profit margin, the total asset turnover, and the leverage. Okay, right, so that's just activity. Then you've got debt ratios. So debt, we'll look at debt later. You have a note in this particular course looking at capital, where businesses can either raise capital through debt or equity. And depending on how much debt or how much equity we use, that's going to affect our weighted average cost of capital. Okay, that's a WACC calculation. That you haven't covered before, that you've only covered now in FIN3701, but it speaks to content you've seen before. So I've just put a note here. When looking at debt ratios, leverage is key. Okay, that's something that will be discussed in more detail. You get financial leverage. Okay, you get operating leverage. Those are other calculations in this course. that speaks to debt and equity. Okay, so how much debt and equity have we used in our business? Okay, remember, in a business, you can decide how much debt and equity you use. As an individual, even if you think about day-to-day living, some of you might have debt for maybe the house that you've purchased, the car, big assets that cost a lot. You might not have enough cash to pay cash for it. So you're not using equity alone, but you're also using debt. Right? You're not going to only use debt. You could use a portion of debt and equity when making a purchase of a very expensive asset. Right? So that's leverage. It was touched on in FIN3701, but it's expanded on a lot in FIN3701. Okay, so this is definitely a worthwhile topic to remember and to recall. The debt ratio is looking at your relationship between your debt and your assets. Okay, how much debt is actually used to finance those assets. Right, there is a debt to equity ratio that's slightly different, but we'll see debt and equity later when we're looking at how assets are financed. Right, times interest earned, also something to consider just in terms of ratios that you've seen before. Not so important for this one or this module. Then you've got some profitability ratios here, gross profit margin, operating profit, and then you've got net profit. Okay, this one's important because, as I said, it comes up in that DuPont calculation, okay, where they've broken up return on equity into three separate ratios. Okay, the NPM, the net profit margin, the TAT, the total asset turnover, and then the leverage. Okay. Right, then you've got a few profitability ratios here looking at external. So you're looking at earnings per share, so the number of shares you've issued. Remember, companies raise capital by selling shares on the JSE. Those are public companies, right? So public companies are listed on the JSE, and those public companies need to report on their earnings. So when you look at EPS or earnings per share, you're looking at something that relates to the external shareholders, people that own equity in the business, not internal. Okay, managers, that's internal. We're going to be looking at other ways to manage the business's internal performance and how to measure that. Right, return on assets, also something that an investor would want to look at. Return on common equity, also something that an investor would want to look at. Okay, so those are separate calculations that you would also maybe perhaps use depending on the level of difficulty in a calculation. Right, then you've got some market ratios here, price earnings and market to book, just some additional ratios to consider. And then this last page is got the DuPont system of analyzing your performance. Okay, so when you're looking at return on equity, ROE, okay, return on equity can be broken up into these three components. Net profit margin being one of them. Okay, that's the NPM. And you've got the total asset turnover. If you take both of those ratios, those two that I've circled there in red, okay, and if you actually offset the two, so if I cancel the denominators there, okay, you're going to be left with profit for the year less the preference share dividend over your return on assets. Okay, basically, so your ROA, right? If you cross multiply those two formulas, right? And then you've also got to take leverage into consideration. This leverage is spoken about later on in FIN3701. They talk about leverage and what leverage means for an organization. Leverage is very powerful. If you've gone through the textbook, if you've studied the theory in that textbook by Gitman, it doesn't matter which edition, newer or older, you'll see leverage is a very powerful tool that can help you, inverted commas, okay, manipulate, not manipulate in a bad sense, manipulate in a good sense. So you can influence, or you can change, or you can multiply your return on equity purely based on leverage, right? You can make shareholders receive higher returns on equity purely based on the leverage that you're using in a company. All right, and remember, all of this is decided on by management. Okay, so if you're in a management position, if you're deciding on like debt and equity, if you use more debt, that's going to add more leverage. And because we have DuPont, DuPont is the ratio that calculates return on equity when you split it into those three categories: net profit margin, total asset turnover. Net profit margin, how profitable is the business? So is the sales team, are they selling? Remember, sometimes the sales team is the problem, and then you would have to investigate that. Sometimes your assets aren't generating sufficient income, okay, sales, right? Maybe you need more assets to do more, right? So that's more internal. Those two things would be internal. The amount of assets you have, the sales team, okay, the margins that you're selling those goods at, Okay, sometimes profit margins are stressed, or not stressed, or under pressure during a recession, and that could be a cause for performing poorly, right? A bad return on equity. And then the last point, this one, the financial leverage. That one is spoken about in this course. You can use leverage to improve your return on equity because leverage is something that you can control. You can use more debt or you can use less debt, and that will affect your return on equity for shareholders. Right, so DuPont, very, very useful system of analyzing performance, okay, looking at the business's operations and seeing what they've done over a period of time. Right, so that's all FIN3601, just a quick little reminder, a very brief reminder, focusing specifically on ratios. Okay, so you've got all the ratios. I have seen questions in the past where they have tested certain concepts this year in FIN3701, okay, where you're looking at this course, and you have had to use certain ratios from 2601. So don't overlook it. This is definitely something that you would have to go back and focus on in a bit more detail. Something else that I haven't given you a slide on is the time value of money. Maybe just a quick question to all of you. Do both of you have a financial calculator?
Yes, I do.
Yes.
Okay. Yes, you definitely need one. And I'll show you some tricks, some shortcuts to help you do longer calculations easier. You'll see I've tried to break it down a bit in some of the slides, but I will elaborate a bit later when we're doing calculations like net present value, NPV, or IRR, internal rate of return. You can do all of that on your calculator. It's very quick, it's very simple, it's very easy. If you don't know how to do it, then please let me know. I'll spend a bit more time just guiding you through the steps to work out those calculations. And you can also use that for calculating bonds and calculating equity as well. Those are skills that you can use in other courses as well. So if you have done the specific module on time value of money, I'm just trying to remember the course code, DSC 1630. You might or might not have done it. If you have done it, then that's fine. You've got much better knowledge and skills regarding time value of money. Right? You don't need too much of it. You just need to discount future cash flows back in time. That's the main skill that you need to remember. Something else that you covered in FIN2601 that you're going to need in FIN3701. Okay, so yeah, just overview in terms of past information so that we can jump into the current course that you're doing. All right, so this course, this financial management course in terms of scope is looking at these three key categories. We spoke a little bit about it earlier. Investment decisions, financial decisions, and then they've given you some of these other financial concepts to consider. Dividend policy, leasing, mergers and acquisitions. Okay, just to highlight a few of the important ones. These three are generally covered in one question. Okay, so you will see a capital budgeting question where you need to take cash flows and you need to discount future cash flows back in time. But before you can do that, sometimes you need to calculate those cash flows. That's the operating cash flows. That's the initial investment. That's the terminal cash flow. Right, I'm assuming that you've gone through some of the content, so when I'm mentioning some of this, it will make more sense. Obviously, later on, when we get to those chapters, then I will cover it in detail, and then you'll see the calculations, you'll see the initial investment, you'll see the operating cash flow and the terminal cash flow. I'm just highlighting this because from past papers, I've seen lots of past papers in the past, and I've always seen a question where they've asked students about the cash flows where they have had to make some sort of capital budgeting decision. Right, it's a very important section there. The risk and refinements, that links to the capital budgeting. So when you look at those three topics, you need to look at them as one. Right, so when you look at the notes, you'll see certain study units link because they all speak to the same thing. If you're looking at long-term investment decisions, remember, an investment is something that you're going to have to decide on today. You need to decide, are you going to replace your assets today? Are you going to invest in new assets? In other words, expand? What are you going to do? And that investment is based on current information that's projected into the future. So when you're doing a capital budgeting exercise, it's always going to be looking at these future cash flows. You're going to draw up a timeline of cash flows, and you're going to be discounting those cash flows today in order to decide whether this investment is going to reap some sort of benefit or not. Right, that's the context. Right, and I will show you this later when we're looking at some examples. Right, for now I'm just giving you context, I'm just painting a picture, so when we're going through all of these different topics, you can see how it fits in. Right, then the next section, long-term financial decisions. Here, I've seen questions, but generally, the only long question I've seen is capital, cost of capital, WACC. Okay, they've asked long questions there, but generally the other sections are a bit shorter. So leverage, you will see a question if they ask it. You might not get all of this. It just depends what semester you write your exam in, and whether you're doing it this year or last year or the next year. Sometimes they pick and choose which questions they give students. But just be prepared, because you can be given any of those types of questions. Right, cost of capital can come up. Weighted average cost of capital can come up. Leverage can come up. Capital structure can come up. Right, and you've got a whole question bank. If you go look at the question bank that I've shared with you, you will see in some years they test capital structure. In other years they test weighted average cost of capital. In other years they test leverage. It all depends. All right, but you will see when you go through past papers, and we don't know. Okay, we don't know what UNIS is going to test. We don't know what they're going to give us, but what we do know is it can come up. Right, and those are nice questions. If they do come up, you should actually be grateful. Working calculation questions are actually better than theory questions. I don't know about your consensus and how you feel about it, but I would always prefer a calculation question over a theory question, purely because calculations are set in stone, inverted commas. Okay, there's a template, there's an approach that you have to follow. Right, and I will show you that approach. I will show you the template. So please just keep that in mind. When you're approaching a specific question, follow the process. Go through all the steps. Even if they've omitted or left out certain information in the question, state it in your answer so that you've noted it. So when the examiner is marking your paper, they can see, okay, this student really knows what they're doing because they've gone through the entire process. Right? The process will never change. If you go look at the theory, so the notes that I've shared with you, all of these notes have been prepared from the textbook, not the UNISA study guide, because as I said earlier today, we have found some gaps and we have found some problems in the past. Okay, it looks like they've improved the course and it looks like they have reviewed it and things look a bit better now than they did before. Right, but I'm just sharing with you that information. Please stick to the textbook, stick to the theory, and follow the correct approach. Go through the steps as the textbook has outlined, because there's no disputing that. Right, you can always go to UNIS and say, well, hey, I've written my exam, okay, you've given me this particular mark, and now we need to appeal or we need to raise certain concerns if you're in that situation. Hopefully you don't land up in that situation. All of you write your exam and you pass, and that's fine. But yeah, if something like that does happen, then just please raise those points. Even email me and say, well, okay, this is what I've done, this is what I've sent, and this is the feedback they've given. I can definitely give you some additional comments or thoughts if you do have some situations like that. Okay, hopefully none of you have bad experiences like that going forward. Hopefully things will be positive and successful for you. Right, and then later on, you'll see questions on dividend policy. This is also a very important section that they can test you on in terms of retention and payout. I have seen a few shorter questions on that. Leasing, I have seen a long question about that, and that's why I've given you those additional 2 PDF slides, just highlighting the leasing, where you're looking at buying versus leasing, and then deciding which is better. Okay, remember, everything we do in financial management, the word manage should stand out for all of you. Okay, as a manager, your decision making is key. You're going to ultimately have those decisions to make. Whether they're investment decisions, whether they're financial decisions, they're still decisions. You have to use facts, you have to use evidence, you have to use calculations to make a decision. Later, same thing about dividends. You decide how much to pay out. You decide how much to keep within your business. With leasing, you decide whether to rent or to buy. Okay, those are 2 decisions. As an individual, you do the same thing. You decide, am I going to buy the house that I'm going to live in, or am I going to lease the house or rent the house that I'm going to be living in? Those are decisions that we all need to make. Okay, so financial managers need to make these decisions, but just remember, it's all business related. And then the last one, I haven't seen any long questions at all with mergers and acquisitions. That's all theory. I have seen maybe a few multiple choice questions in the past when they used to give students multiple choice. I don't know what the structure is. UNISA should communicate with you exactly what the structure is going to be, whether they do give you some multiple choice or short questions. But yeah, that'll be communicated to you each year, just in terms of your layout for the exam. Right, so that's scope. We're going to dive into each of these sections as we continue through the next few study units. Okay, there's 6 study units in total. Okay, so I'm going to cover the first 3 in the first half, and then give you all a break just to refresh, recover, and then come back again in the last session just to look at the last 3. All right, the most important ones I will highlight. I will share with you my thoughts and opinion on which are more important because of past papers that I've seen, and just to help guide you in terms of focus. Right, I know you're busy, I know you're working full-time and studying part-time. All UNISA students generally are in that situation. All right, so let's dive into topic number 1, capital budgeting, where we're looking at cash flow. Right, cash flow is important here. Okay, remember earlier I spoke about time value of money. Okay, when you're looking at this particular section, study unit 1, you need to remember time value of money because those cash flows are future cash flows. Those cash flows are based on what we expect. Okay, remember we said, because this is budgeting, I'm sure all of you have some sort of budgets. Okay, if you look at your budget is an expectation. Right? You think you're going to spend a certain amount of money on a certain expense. Okay, you think you're going to need to save up a certain amount of money for a certain asset purchase. Okay, that's all budgeting. Budgeting is looking towards the future, but it's bringing it into the present because you need to make a decision. Okay, and that's what you're going to be looking at here. So if you're looking at learning outcomes, initial investment, very important. Operating cash flow, very important. And terminal cash flow, also very important. Depending on how complex the question is, I've seen questions that are out of like 20, 25 marks where they've tested students on all 3 of them in one question. But then I've also seen shorter questions where they've only tested you on one component, the initial investment or the operating cash flow or the terminal cash flow. Right, so you have to decide in terms of difficulty, when you get to a question, scope out the question and look out for these things. Okay? Ask yourself, what is the primary goal of the company? What is the company trying to do? Okay, if it's capital budgeting, the question is going to be phrased in terms of maybe making a decision. Are we going to expand? Are we going to replace a machine? Okay, those are the type of questions you're going to be asking yourself, and that's the giveaway, right? So when you're looking at past papers, look at the actual scenario, look at the information they've given you, even look at the required. Right, if the required is talking about anything related to cash flows, anything related to investing or expanding or replacing an asset, it's a giveaway. It's a capital budgeting question in the exam. Okay, whether it's a long question or a short question, that we won't know, but what you should know is the approach that you're going to be taking. Right, and this is what we're going to be looking at. So, capital budgeting decision making. Okay, remember, we're thinking about reasons why a business would want to spend money. Remember, capital has to be raised, either through debt or equity. Okay, that's a financing decision. That's that second category, or that second arrow that I showed you earlier. I can go back here quickly. Here, that's financing. Financing, just to give you context, is where do I get my money? Do I raise money through debt, or do I raise money through equity? Right? Do I use my money or do I use someone else's? That's basically what you're trying to decide on. Investment decisions, that's different. That's looking at projects, that's looking at assets, that's looking at businesses, where you're going to use your capital. Right, so to give you context, if you're looking at this slide, slide 14, capital expenditure talks about that process. Right, if any of you are in finance or in procurement or at some level in your organization where you have some sort of decision making, right, you'll be given a budget. Okay, whether you're in marketing, finance, IT, wherever, right, every single department in an organization is going to have capital expenditure. Okay, you have to buy things, you have to buy assets, you have to buy laptops, PCs, you need to buy machines, you need to buy vehicles, you need to buy equipment. All of that is considered capital expenditure. Right, so when you're looking at this topic, when you're focusing specifically on topic 1, think about that, remember that, because when you're looking at your exam, you can easily pick out the question that's capital budgeting. Once you've picked out the question, then I'm going to show you all the workings you need to do for this section because it relates to capital budgeting. It relates to decision making. All right, so that's why you have the slide. It's to give you context. If we had more time, if we were doing this on a week-by-week basis, then I would have discussed a lot more of these questions in more detail. But remember, it's a crash course. I'm just giving you the need to know. Okay, what you need to know is capital expenditure is taking money that you've raised. Remember, we're going to look at financing later today. When you look at financing, you're looking at debt and equity. If you're raising capital, your choice now is to decide, okay, now where am I going to utilize that capital? Am I going to utilize the capital in my business? Am I going to buy assets? Am I going to invest in different companies? That's something that you need to consider. Right? That's the context. Okay, context is key. If you've gone to the textbook, they've spoken about these 2 key areas. And UNISA will test you on one of the 2. But if they give you a capital budgeting decision, it will either be expansion or it will be replacement. If it's expansion, it's a lot easier because then, maybe just to add a note here, there's no old. Okay, if any of you have done any of those assignments or workings looking at capital budgeting where you have new and you have old, if it's an expansion decision, okay, the old asset has no relevance. Okay, you'll see me talk about the word relevance later. Okay, relevant costs, relevant expenses. Okay, those amounts that are incurred when you make a decision. Remember, let's keep the context. What is the decision? The decision is, am I going to buy a particular asset? Am I going to invest in a particular business? By doing that, that's going to give rise to capital expenditure. If it's expansion, then I'm not going to worry about the past. The past has no relevance on the present. If I'm looking at replacement or renewal, then the old is important. Okay, you have to consider it. Because replacing the old asset with a new asset does give rise to certain costs that need to be considered. Because the decision, remember, decision making, I'm going to choose to get rid of the old assets and I'm going to replace that with a new asset. By getting rid of an old asset, that's going to trigger certain tax consequences. Right? So for example, if we're a large organization and we have lots of equipment, machinery, we've got big assets, okay, we've got capital assets. Those capital assets, machinery, equipment, okay, even land and buildings to some extent. Okay, if I'm going to sell or dispose of those assets, in other words, replace those assets or renew them, then I'm going to trigger certain tax consequences. And that's where deductions come into it. So you'll see there's a tax saving or there's a tax saving or a tax, like a payment that you have to make, a deficit, something that you have to pay, right? So remember that, keep that in mind, especially when you're looking at these 2 categories, right? You'll get one or the other, right? It has to be one or the other. Expansion you should be hoping for, it just makes your life a lot easier because the old assets don't have any relevance, right? If it's replacement, then they do, then you definitely have to consider it. Okay, the other is not so important, that's just there purely for information purposes. All right, capital budgeting. Okay, the reason why you have this slide is because it's a process. Okay, you have to go through the whole process to decide on whether you're going to actually go through with the decision or not. Okay, that's something that you're going to have to decide on in an exam question. Sometimes they even ask you, am I going to replace this asset? All right, should I replace the asset? Is this going to create more value? Right, is this going to generate some sort of benefit? Okay, is that going to increase the value of the business? Right, and that's something you always need to consider. Right, so these are the categories that you should be looking at when making a decision. Okay, when you're deciding, if this was a theory question, I haven't seen long theory questions look at capital budgeting. Not to say it can't come up though. Right, if it does come up, you would have to think about the different considerations. You'd have to think about the costs. You'd have to think about the purpose. Okay, why? Why are you expanding? Why are you replacing? Okay, and all of that's spoken about in the textbook when they look at this process. All right, so this is theory. If you go through the textbook's very good. Okay, so please always use that as your source of theory, your source of information. Right, you'll see they discuss this budgeting process. Okay, when we're looking at questions, UNISA is generally going to be focusing on here, the decision making. Okay, when you're looking at decision making, you need facts and figures, economic viability, right? And that's where the dividend discounting comes into it, right? Remember, if somebody's asking you, okay, you already have, let's just talk about IT. Okay, the IT department, they've already got a whole bunch of servers, laptops, desktops, tablets, etc. Right? If they're ever going to want to, let's say, replace, they need to talk about economic viability, right? They need to do the number crunching. Okay, they need to show, well, okay, if I'm going to replace all these machines or the technology, what is the future benefit? What is the potential future benefit? Is that going to create a inflow of economic benefit in the future? Right? If it's not, then why are we replacing these machines? Why can't we use them for another year? All right, so when you're looking at test type questions, your focus is generally here, decision making, or here, economic viability, right? Because you need calculations. Right, UNISA is going to ask you to calculate initial investment. If you're going to expand, how much is the initial investment going to be? If you're going to be operating, what is the operating cash flow over a period of time? Or right at the end of the project, is there any terminal cash flow, and is that going to affect your decision to expand or to replace, depending on what they've given you? Right, so the focus from a test point of view on those two steps, okay, number crunching and then ultimately making a decision. Right, the rest, not really that important. That's just more additional information from a practical point of view. Right, cash flows are key. We spoke about different cash flows. When we're looking at questions, you need to understand what type of project you have. Okay, this is very, very important when looking at decision making, because you need to decide if those cash flows are going to be affected or not. Right, remember we said cash flows are key. Right, so if I'm thinking about a business or a project, okay, let's change focus and talk about a project. If I have an independent project, because it's independent, that means I can accept more than one of those projects. So if I choose A, I can also choose B, I can also choose C. The problem comes in is if it's mutually exclusive. Right, that's the other form of project that you can have. Right, mutually exclusive means if I decide to do something, it's going to eliminate the other project or the other option, okay, the other situation. Think about it in terms of two, it's like an opportunity cost. I don't know if, I'm sure all of you have probably covered some form of economics. Okay, maybe just ask for interaction. Does anyone know what an opportunity cost is? Parosha, Damien?
Yeah, the cost, your cost benefit of choosing one project over another.
Yes,
Yeah.
100%. So opportunity cost is when you've lost out on something. They use the word forgo. If you go read the definition, opportunity costs are actually spoken about in FIN3701 actually, but from a financial point of view. And then in economics, they talk about opportunity cost more general. But your opportunity cost is basically what you've lost. Right, so if I have a mutually exclusive project, if I choose project A, I'm actually giving up project B. Okay, or if I decide to replace an asset, replacing the asset, okay, is actually going to remove an asset. So there are certain costs. I can't, for example, if I'm replacing an asset, I can't keep the asset and also replace it, if that makes sense. Okay, replacing means getting rid of it. In other words, I have to decide, do I keep the asset and then I expand? So I keep the existing asset and then I buy a new one. Right, if I buy a new one and get rid of the old, okay, that's a mutually exclusive project, okay, or a mutually exclusive decision. Because choosing to replace, okay, means getting rid of an old asset. Okay, expansion is different, that's independent. Okay, so just remember that context, because depending on the type of question you have, they might ask you to make a decision. Right? If they do give you two options, okay, you always need to decide, okay, which option is better, and you need to make a decision on whether to go with it, accept it, or reject it as an option. Okay, just a bit more theory, capital rationing. Sometimes I have seen one or two past papers where they've given you actual amounts, capital, as a consideration or a limitation Okay, they might say, for example, let's say you've got 2 million rand, okay, and you need to buy an asset, okay, and that asset might be costing, let's say, 1 million, right? But you've got 2 or 3 different assets, all right? So obviously, I can't buy excessive amounts of assets if I'm going to overspend, right? So capital rationing is where you have a limitation placed on the amount of resources you have. Okay, even for big businesses, resources are limited, right? So look for that. If you have a question where capital is given, they tell you this business has a certain amount of capital that they're going to invest, and you've got different projects. Okay, and you need to look at the initial investment, because the initial investment is how much it costs you to spend money to get the project running, okay, to launch the project. Okay, so it does affect your accept and reject criteria. Okay, sometimes you accept and reject. For example, you might have 5 different assets, and all 5 assets are good. Their net present value, their NPV calculations are all positive. All right, you'll see some NPV calculations later. Or the IRR, the internal rate of return. Those rates of return, the IRR, is greater than all your weighted average cost of capital, okay, your WACC. Right, again, based on decision criteria, which you'll know later, right? If IRR is greater than WACC, I'm going to accept every time, all the time. All right, but if there's capital rationing, I'm limited. Then I need to choose the best projects, right? And that's where ranking comes into it. Okay, you'll see if you've gone through the past papers, you probably haven't yet, but when you do, please go through past papers. The best approach that I can give you is to practice answering questions, as many questions as you can. All right, so maybe pick and choose the questions you want to do. Try do it, and then check the working or the solution that I've shared with you, and see how it goes. If you have any questions or comments, I'm always available. You're welcome to message me, email me, text me on WhatsApp, and we can have a short little discussion. Right? I'm here to support you until you get to your exam. Okay, the 17th of May is the main date for semester 1. So as long as you've gone through past papers, you should be on the right track. Okay, if you get stuck, let me know. I'm more than happy to assist. Okay. All right, so that's something to consider when looking at decisions. We need to look at the calculations. Right, so when looking at calculations, cash flows can either be conventional or non-conventional. Conventional means we only have one outflow and then we have inflows. All right, so there aren't any outflows after you've spent money initially. Okay, when I talk about initial, if I'm looking at time value of money, which you'll see later, okay, initial investment always talks about T0. T0 referring to today, now, okay, initial outflow. If I'm looking at non-conventional, then there can be outflows later on in the project's life. Right? That is a possibility. Right? If it is, then you're going to build that into your time value of money. Right? The reason why I'm showing you this is because you can build a timeline when you're doing these calculations. Right? So if you're looking at this example, obviously if I have minus 200 at some point in time after I've already started the project, that could be seen as non-conventional. Okay, non-conventional, there's outflows later on in the project. Okay, when I look at time value of money, I need to remember 2 workings that are vital. NPM, okay, not NPM, NPV, okay, net present value, and IRR, internal rate of return. Okay, these are 2 things that you also would have looked at previously, actually. So again, just to ask you, just in terms of context, just so I know how well you are coping with your time value of money. Have you done this in other courses before? Maybe you've done DSC 1630, or you've done other finance modules or other investment modules where you've done NPV and IRR. Just asking both of you, do you know how to do NPV and IRR calculations?
I haven't done it in past modules, but I kind of have an idea of how to do it from this module.
Okay, and then Damon?
Yeah, about the same. I picked it up
same.
in 2601.
Okay, all right. So yeah, we'll definitely have to recap it then. If you're a little bit rusty or not so familiar, we'll go through it. There are some notes about that. Okay, I see there's a message here. Looks like Teams has, normally they, okay, looks like they've added a time restriction. I see there's only a 60-minute meeting time. Okay, so
What?
if the meeting time does end, then it's fine. We'll send out a new link, or we'll join with the same link. I don't know if we can do that, but I'll mention that just now. Yeah, so if it does time out, please bear with me. I'll either send out a new link, or we'll try join with the same link and see if it'll let us in again. Okay.
Okay.
Right. So when looking at cash flow, NPV, and IRR, when we're looking specifically at decision making, remember the context here is capital budgeting. This is your decision criteria. Okay, so once you've calculated NPV, you need to decide, is it greater than 0 or is it less than 0? If it's greater than 0, we're definitely going to accept. Okay, so greater than 0 means good. That means value has been created. Okay, that means accept the project. Okay, if it's not greater than 0, if it's equal to 0, then the I was achieved. The I is referring to internal rate. Okay, we'll talk about IRR just now. It's here, but I'm just highlighting NPV. NPV, if you've gone through the textbook theory, NPV is the best measure of value. Right, NPV looks at value in terms of discounting future cash flows back in time. Right, I think FIN3601 actually was the first course that introduced you to these concepts. Right, and they've just taken it a bit further here. It's the same working, it's the same calculation, it's the same decision criteria. But you just need to think about the additional when you're looking at cash flow. Right, is it conventional, is it non-conventional, is it expansion, is it replacement? Okay, are we going to accept, are we going to reject, and is there any capital rationing that could be present in a decision? Right, but we'll see that as we go. All right, the next thing, internal rate of return. Okay, this is an IRR calculation that you actually do on your calculator. Right, so none of you should be stressing about NPV and IRR. Right, your calculator can do the working for you. It's actually quite simple. It's quite easy to do. As long as you know how to insert the right numbers into your calculator, you can get NPV without much effort. Okay, same with IRR. IRR, you actually can't work it out manually. NPV, you can. IRR, you can't. Okay, that requires a repetitive mathematical calculation. It's called Newton's method. If any of you have done maths or one of the maths modules, they talk about Newton's method. IRR is it's like repeating a process constantly until we get the IRR that best matches this cash flow. Okay, but fortunately we have nice financial calculators that can do the calculations for us. That IRR is important because it's a rate. That rate is going to be used later when you're describing weighted average cost of capital and you're comparing it to the weighted average cost of capital. Okay, that's something we'll deal with in the financing section. Okay, right now we're looking at investment decisions. Right, relevant cash flows. If something is relevant, that means it's going to affect the decision. Okay, when you're looking at relevant cash flows, you need to think, is this replacement or is this expansion? If it's expansion, it's easy. You can forget about the old assets. If it's replacement, then you need to look at the old assets. Right, so UNISA generally tests, if they give you a long question, they're probably going to test the replacement because they want you to look at the old and the new. Right, when you're looking at this section, you need to remember INV, that's one calculation. Operating cash flow, that's a separate calculation. And then initial is beginning, terminal is end. Terminal cash flow, TCF, is the one at the end. Right, please note that all three of these are separate. Okay, because all three of them point to a different place on the timeline. Okay, remember the timeline shows you all the cash flows over a period of time. Okay, think time value of money. Right, so when you've got initial investment, that's at the beginning. Okay, that's at T0. Okay, you'll see a slide later where I've put all the cash flows on one timeline. This would be over time. So this would be T1 ... to Tn, whatever the n is. Okay, and then terminal cash flow is right at the end, so Tn. N meaning at the end of the period. Okay, so if it's a 5-year project, terminal cash flow will be at T5. Okay, T0 would be at the beginning. Okay, and then operating cash flow will be over the 5 years for year 1, 2, 3, 4, 5. Right, so that's important. Okay, I've seen students make mistakes in the past where they haven't put the cash flow in the right place. Right, be careful. Read the information, think about the timeline, and then pull out the information and say, okay, this information relates to the beginning, this information relates during, and this information relates to the end. Right? If you can do that, you'll find past papers quite easy to tackle. Okay, just think about that. Picture a timeline, decide, am I looking at initial, operating, or terminal? Okay, and remember, when you're calculating these three, you'll have separate workings for all of them. All right, so this is the summary slide in terms of cash flows. Right, on the next few pages, you're going to see all of them, okay, separately. Right, so the first one, initial investments, okay, looking at replacement decisions. All right, remember, replacement means I'm going to take my new asset, I'm going to purchase a new asset, and I'm going to remove or get rid of the old assets. Right, you'll see all of those are important. All of this needs to be highlighted. Why? Because it's important. Okay, your old asset is always going to have relevance. Okay, note the words I'm using. Okay, relevance, relevant costs. Okay, if I'm looking at a replacement decision, the old is relevant. We have to take it into consideration. We have to include it in the calculation. Okay, next slide talks about expansion versus replacement. Okay, if it's expansion, you should like expansion a lot more. Why? Because what we just said doesn't apply. Okay, there will be zero inflows or outflows from the old assets, but you still use the same workings though. Okay, so your approach doesn't change. I'm still going to do all of these calculations, even if it's expansion. Okay, if it's replacement, it's a little bit more difficult because this needs to be built into your calculation. Okay, remember, show all of this. Okay, you're going to see an example later in your notes, right, where I've shown all of it. You have to show all of it, right? Remember, even if they don't give you the information, show it and then just tell the examiner that not enough information is given, so the one amount is zero, okay? Or this amount can be calculated and I can work it out, and here's the calculation. This is my after-tax liquidation inflow from the old. Okay, remember, when I sell an asset, I'm going to get money from that sale. That's going to affect the replacement decision, right? How much are you going to get from the asset that you're going to sell? Okay, and I'm sure all of you have, if I think very logically, very practically, as an individual, I'm sure all of you at some point in time probably would have thought about upgrading something, whatever the asset is, be it your phone, be it your vehicle, be it your house, whatever it is, okay? And I'm sure you probably would have thought about it, well, am I going to sell my old assets and replace it with a new? Okay, this after sale, this after tax proceeds from the sale of the old asset is what you get when you trade in your vehicle, or you trade in your phone, or you sell your existing property to buy a new one, whatever the case might be. Right, so it's very practical, it's very simple, but it's something you need to remember. Please don't forget that, because if it's replacement, they give you lots of marks for these workings. And sometimes students forget about that because they're just thinking, okay, it's just this, it's just this, it's just this. And then they don't remember that this has relevance. Okay, so I'm stressing it because it's important. Right, sunk costs, I've seen theory questions about this. Sunk means I cannot get it back. Okay, so research and development or marketing, those are sunk costs. Opportunity costs, we spoke about it earlier, those are relevant. Those definitely affect the decision. Right, so when I'm looking at relevant costs, opportunity costs will always be added to the calculation. Sunk costs will be taken out or removed. Okay, if you do have sunk costs in the exam question, state it. Tell the examiner, these costs are sunk costs because they have already been made and they cannot be recovered or recouped later on in the project, so they will not be relevant to the current decision that we're making in terms of accepting or rejecting the project. Okay, so think about those things. That's what I'm saying. Use these slides, use these notes to guide you in terms of approach. Okay, when you're reading the question, if it's capital budgeting, all of these slides are going to be in my mind, and I'm going to be thinking, okay, expansion, replacement. If it's replacement, I need to look at the opportunity cost for everything, even the old assets. Okay. All right, the next step. All right, the next few notes. So just to give you context, from page 25 onwards, you've got all the calculations that you need for capital budgeting. These are important slides. If you're with me, if you're making notes, please note slide 25. Okay, this is the slide that you need for initial investment. Okay, if you've looked at the past papers, every time I've ever been given a question on capital budgeting and they're asking me about initial cash flow, initial outflow, or initial investment, you're always going to write this down. That's your template. Okay, this template even comes from the textbook. Okay, there's a question, Damien. Yeah, please interrupt if you, I see the hand. Yeah, question,
Yeah.
yes.
Just on the sunken costs, does that get included into your initial investment? If
No.
say now you're doing, okay.
Yeah, you don't. Okay, sunk costs. Sunk costs are costs that you've already spent money on. Those are things like research and development before the project even starts. So remember, for example, like let's think of an example. Okay, let's say you're going to start a new. You're going to develop a new car. Okay, you're going to create a new car. You're not going to develop a electric car. You're going to develop a hydrogen car. Right. That research and development, all of those costs that go into researching the science behind the vehicle, okay, if I'm going to go hydrogen rather than electric, that is a sunk cost, right? That's even before you've built the factory. So before we're going to build this factory that's going to produce these cars that use hydrogen, we need to like remove those costs.
I'm just curious. So why wouldn't you include it? So if you're running a project, for example, on hydrogen cars, and you've built your factory, so your initial investment would be all your materials, your factory costs, all of that. Why would you not include that sunken cost?
Because those costs were previous, before you actually decided. See, you've already made the decision. What you're telling me is we've decided to already go with hydrogen production cars, and we're going to produce those vehicles. The decision was made. We're looking at before you even decided. So, before the company even started, all right, any sunk costs are not considered before the project. So maybe, I don't know, maybe Tesla's going to go hydrogen instead of electric, okay? Whatever development or whatever thoughts went into hydrogen, those are considered sunk, okay? But if it's existing, if they've already made the decision, then it's relevant. Does it make sense?
Yes. I'm just trying to figure out in terms of like the overall management. I know it might be going a bit ahead, but
no, it's fine.
Where do you consider your sunken costs now in your
it's a very good question. So UNISA will always give you costs that are quite obvious. So obviously, if it was a practical like sense, like if we were practically deciding on whether we should do something or not, it can be a little bit more subjective. Okay, you might have an opinion. Well, you might say, well, okay, this is something that I do need to consider, and someone else might say, no, they don't have the same view. So in reality, it can be debated, but in a UNISA exam setting, it's going to be quite specific. Right, it will be quite obvious. They'll talk about like past marketing costs or past research costs or development costs. They talk about the past, not the present, or the future. Okay, if it's present or future, it's relevant. If it's past, it's irrelevant. That's basically what a sunk cost is. A sunk cost is irrelevant past costs that don't affect the current decision.
Cool.
Okay, yeah, good question. All right, so yeah, just coming back to that note, please highlight, circle, underline from this point onwards, from page 25 onwards, these are calculations. You are always going to use these templates in any question, right? If the question has anything to do with capital budgeting and they're asking you to do the initial investment, make sure without fail you write down all of that. Whether they give you the information or not, write it down because you'll get marks for your workings. Okay, then go through the test question and find the new costs and then put the working in. See if there's installation, put that working in. Okay, and that's good exam technique. Okay, so when you're doing your exam paper, follow the right exam technique. No one can change the approach. The textbook outlines the approach. They've given you a certain method that you need to follow. This is the method. You're going to write down and then you need to follow it. Whether they give you all the information or not, that needs to be seen in the exam question. Okay, sometimes they will talk about the old asset and the new asset, and sometimes they'll give you lots of information. Sometimes they will give you installation costs, sometimes they won't. All right, if they do, include it. If they don't, then just put 0 here. Okay, put 0 here and say no installation costs given, okay, but still show your workings. So in the exam, you'll see, if you've looked at my past papers, you'll see my answers. I've always got the template, and then I've got those notes. Okay. All right, so when we're looking at relevant costs, remember, any capital budgeting question that requires an initial investment, please, 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 please follow this template. Okay, use this template. It's everything that you need when doing calculations for initial investment. All right, I will show you with an example how to do it. All right, but that's the important slide. So there's one slide that you need to bookmark. It's definitely page 25. The rest has been just mainly theory and revision. This is the first time where we're actually looking at something practical. Right, you should get a question about this. They generally test it. I just don't know how big the question is going to be. It might only look at one of these. It might look at all three of them. We'll have to wait and see. You can all give me some feedback afterwards once you've written the exam, and you can tell me, okay, this came up or that came up or whatever. But yeah, if this does come up, okay, it should. It normally does. Right, when you're calculating initial investment, please note, I've stressed this, it's at time 0, meaning now. Okay, so when you picture that timeline in your mind, okay, you'll see it later. I've drawn it for you already. Okay, but just picture a timeline for now and just picture at the beginning. Okay, so when you read a question, here's the question that I've given you. This is just my own example. Okay, just highlighting something that they'll give you. Remember, the question's not going to look like this. Again, exam technique, they'll give you like a long paragraph. They might even give you a whole page of information, and they might split it into different categories. Okay, when you're reading through the information, please make sure that you highlight, circle, underline things that relate to the initial investment. Okay, in other words, T0. Ask yourself, as you're reading through it, okay, is this T0, is this T0, is this now, is this now, is this now? If it's now, then note it, highlight it. Okay, so what I've done for you here is I've just bulleted points that you would have highlighted from the actual question in an exam that you would have highlighted or noted while you were reading through the question. Okay, and this is what I was looking for. All right, taking all of this out of like the context that they would have given you in the actual situation. Right, once you've got this information, now I can use it. Okay, so company A will replace. That's a giveaway. You would all be highlighting that because now new and old both have relevance. I need to use those workings, okay? And I need to have amounts for both the new and the old. Okay, so they've told me A is going to be replaced. Okay, company A is going to replace an old machine with a new one. The proposed new machine costs 2 million and there's 200,000 Rand installation costs. Okay, that's a giveaway. Sometimes questions will have it, sometimes they won't. If they've got it, use it. And it doesn't always have to be called installation costs. It can be like spoken about differently. They might say, well, the mechanic or the technician needs to install, or they need to, I've seen different ways of describing it, but remember the word that's going to stand out for you is, well, do I need to actually install it? Do I need to fix it? Like, does it have to be, like, what's the, install, how else can I describe? Yeah, installed. So that's just something that you need to be mindful of if they do talk about it in the actual question. Something to also consider, acquisition costs or delivery costs, things like that, transportation. Those are also things that we need to consider when looking at initial investment. Right, depreciation. You might be wondering, well, how on earth is depreciation relevant? Okay, because depreciation, first of all, is accounting. Depreciation, second of all, is a non-cash item. This is all revision from previous courses that you've done. Okay, depreciation is a non-cash item. It's not cash flow. So why would it be part of your calculation? Well, remember, depreciation, yes, is non-cash, but depreciation is going to reduce the value of an asset over a period of time. So when you do decide to sell that asset, okay, there is going to be some sort of tax consequence when that happens. All right, so depreciation is important, not because it affects our costs going forward. Depreciation is important because it affects the old assets. It affects the old machine. And that's why it is relevant. Okay, it's relevant to the old machine because I need to take it into consideration. Okay, this is more important later when you look at the operating cash flow. Okay, for now, we're only focusing on initial investments. So the only thing that I'm going to be highlighting is this. Okay. What else do I have? The old machine was bought 2 years ago. for 800,000. Okay, that's important, right? Because remember, that's talking about the past, but now I'm making a decision now in the present. Okay, so I need to know in the present, how much is this old machine worth? Okay, that's important. So NB, carrying value. Okay, I need to know how much is that asset worth today? Because remember, I'm looking at the current decision. Okay, the current decision is affected by this old machine that I've had for 2 years now. Okay, I bought it 2 years ago, I'm still using it, but now the decision is to replace. If I'm replacing this asset, I need to know how much it's worth. Okay, see, those are marks that you get in your exam. Right, calculating the carrying value is going to give you marks. Determining what the proceeds, the after-tax proceeds on the sale of this old machine is going to give you more marks. Okay, and all of that is relevant. All of that needs to be shown in your calculation. Right, so I'm just highlighting exam technique as we go. Okay, I'm reading the question, I'm thinking about these things. Okay, yes, this was 2 years ago, but it's still relevant today because the current machine has a carrying value. Okay, we know accountants keep track of the carrying value. You'll have the carrying value every year. The machine will depreciate every year, and every year the asset will lose value. Right, the buyer will pay 600,000, a buyer will pay 600,000 for the old machine. Okay, again, it's looking at the current situation. Remember I said initial investment T0 now, okay? Always remember you're looking at today. All right, today, as we sit here, today this machine can be sold for, a buyer is willing to pay 600,000 for the old machine. All right, that would be something that you would have to take away from the question. Okay, again, it's relevant for today, today's decision. And the last thing is just about working capital, what impact working capital will have on our business's operations. This is a separate topic. This is FIN3701, okay, the short-term financing module. Okay, this is all long-term, so you don't have to work this out. It'll always be given. Okay, I've never ever seen a question where they've asked you to work it out. Okay, if you're doing FIN3702, then yes, you're going to have to work it out, but for this module, it'll always be given. Okay, or they'll talk about working capital and how it'll change. And then the last thing is tax. Okay, so I've just used 30% here just to keep it nice and simple, and then you've got your solution. Okay, remember that format that I showed you? There's the format. Okay, what I do next is I take all that information that I was contemplating and working throughout the question. Okay, remember the exam is going to give you a question. Everything I had here was what I pulled out from the question. Then I just take that and I insert that into my template, that template I showed you on the previous slide. Okay, so we just read it. There's the 2 million, there's the 200,000 installation costs. Okay, there's the proceeds from the old, and here's the tax on the sale. All right, this tax on the sale, this is calculated based on how old the asset is. Okay, so when you're looking at calculations, just keep that in mind. Okay, it's the tax on the sale. All right, so in other words, what is the asset worth today? Okay, what is the asset worth today? Well, let's think about it. Okay, when did you use this asset? Well, you bought it 2 years ago and you've used it for 2 years. Does that make sense?
Yes.
Okay, so if you're looking at 800,000, grab your calculator quickly. On your calculator, remember this is straight line. Straight line is easy. So obviously it's 800,000, okay, divided by 5 is 160,000 Rand depreciation every year. Does that make sense? Okay, this is actually a separate course. This is more accounting than anything else, but I'm just going to write it down in case you are wondering. Okay, this is per annum. All right, you need to know some of this from previous courses. Okay, so I think you also have to do accounting before you get access to this module. So you should know how to work out straight line method depreciation. Okay, it's easy. I just took 800, I divided by 5. Okay, if I divide that by 5, I get 160,000 per annum. Does that make sense?
Yep.
Yes.
Okay, if I then work out the carrying value, what would the carrying value be? 800,000 less 2 years worth of depreciation. Does that make sense?
Yes.
Okay, gives me what? Let's work that out. 800,000 less 2 years of depreciation gives me 480,000. Make sense?
Yes.
Okay, so 800 minus 160 minus 160, 2 years of depreciation gave me 480. Okay, 480 NB is the carrying value. That's the CV. Okay, this 480,000, remember? How much is someone going to pay for this asset?
600.
600,000. Okay, so what is the tax consequence of this? Well, there's a gain here. There's a capital gain here. Right, I've got 600,000 proceeds. I've got 480 carrying value. Right, so 120,000 is taxable, right?
Yes.
Okay, so 120,000 times 30% is 36,000. Does that make sense? Can you see how I got that?
Yes.
Okay, yeah, that's just a tax calculation or an accounting calculation. Remember, it's calculated using accounting, okay, using your knowledge of depreciation, okay. It's carrying value. So proceeds less carrying value will give you a profit or a loss. If you have a loss, then this wouldn't be a tax, how can I refer to this? This would be a tax deficit. It'll be a tax saving, okay, if it was a loss. Okay, here we made a profit. We sold an asset at more than its carrying value, so there's a profit on sale. If there was a loss on sale, then there would be a tax saving rather than a tax like consequence, okay, a payment. I have to pay SAR something. All right, let's think about what we just spoke about earlier.